Claudine, are you there? Claudine?
My mic was muted, sorry. Yes, I am here. I've made you presenter. I've added your admin. I've started your recording, sir.
How are you doing?
I'm doing well. Today was such a beautiful day. I'm sure everybody that was working from home was thinking, why am I working in my house today when it's so beautiful?
But it's actually cold when you're inside the house, eh? Because I even tried to open doors and windows, but it was still cold. I have my heater on as I speak to you, and I have a jersey on. So.
Okay, by the way, I have the issues of old women.
No,
anyway.
outside it was sunny, eh? But it's just inside that's the problem. So, but anyway,
No, you must
Thanks.
have a good lesson, and I won't speak to you again before next week. So everybody must have a good weekend, a nice long weekend. Tomorrow night is our last sessions for this week. I think even students, everybody needs a break just to
Yes.
spend time for themselves.
Yes. No, they need to spend time with their books.
Spoken as a true educator, it's time for me to leave.
Thanks,
Bye.
Claudine. You must keep well. Cheers. Bye. Just need to pull up the question quickly. Okay. So good evening to everyone. So last week we've missed a class because due to my unavailability. So this week now we're going to cover session question that we're supposed to cover. Okay. So in terms of the schedule itself, we're supposed to cover 2 questions today. But I think we're not going to do as such. So we'll do just 1 question today and then leave the other one for the next session. Because even though question 7 is very small in terms of the information presented in there, but I think in terms of the principle, it covers various aspects, or it covers various disclosures that you actually required to do. So it might take us perhaps an hour, even more than an hour to actually try and do that, right? Okay. So today tonight we're doing question 7, and that question comes from tab letter 102. So as previously done, what I'll do is when we read the question, so when we read the question for now, we will read the question together. So I'll put up on the screen. But now, as soon as I start using or start answering the question, then I will put the question off and then only use my answer sheet that will be in front of you, because I actually want you to see how you actually get to certain amounts of where to certain amounts fit where within the required itself. So the method that you're going to use today is the same as what we've used in the previous session, in terms of your starting point, trying to analyze the question, what it is that's happening. And then the second part is reading the required understanding as to what it is that they require from you to do, but also in response to that required as well, what is the trick, or what is the response or the skeletons that you then need to prepare upfront in order for you to be able to answer that question as quickly and generate as much marks as possible, right? Okay, so what I'll do is I'll just share the screen now with the question. So remember, what we'll do is we'll ask each other questions, we answer, we engage in all those kind of things, because that's going to be a way of perhaps that's a way of trying to assess whether what has been presented on here, you are on the same way understanding in terms of what we're trying to achieve here. So even if you think your answer is wrong, at least you need to try and attempt, so that you at least know what you know and you know what you don't know, okay? And it's going to be very brief questions, very short, nothing long, and then you can type that in the meeting chat box. Okay, fine. Now I'm going to put up the question quickly. Okay, where's the question? It's this one. Okay, I just hope everyone can see. I want to keep this one open so that I can see what's going on here. Okay, there you go. Okay. So question, if you've read question 7 up front, question 7 deals with IS8 principles. And in my honest view or opinion, it was a fairly simple or fairly straightforward question, very short. But in terms of the required was at least a bit stretched out. There were many things that were looking for, but in terms of answering that required, it was a very straightforward question, right? Okay. So the following information is the following information of Stockit Limited for the financial year ended 30th June 2023, or let's just say 2003, is presented to you. So very important, it's after the draft financial statements for the year ended 30th June 2003 have been prepared. So the directors of the company, they decided to value the inventory in accordance to the first in, first out principle or method. This is in order to improve the matching of income and expenses instead of the weighted average method as previously done. Okay, so we know already initially they've used the weighted average method, but now they've changed to first in, first out. Okay, that's fine. Now, the profit before tax for the year ended 30th June 2003. They've given you it's 4476, and then 2002 it was 2,040,000, right? Very importantly, it says you have not taken into account the changes in accounting policy. That's very important because in essence, what needs to happen is that if they ask you to perhaps prepare your profit before tax now with this information, you will need to do certain adjustment to reflect this change in accounting policy. So it's very important that whenever you come across important things, you highlight so that you don't forget that. So that before is very important. Something in my mind needs to be done, right? So your retained earnings at 30th June 2001 amounted to 2.9 million. The tax rate remained unchanged at 28% for the past 5 years. Okay. The company provides for deferred tax on all temporary differences using the statement of financial position approach. So that has been the method that we've been using all along. So the question is going to tell you what approach you need to use. So nothing has changed, right? And then the company had no taxable or deductible temporary differences since its incorporation. That's fine. Yeah. Now, up until the 30th of June 2003, inventory was valued according to the weighted average method. We already know because in point 1, we've already ascertained that information, right? This method was also applied in the draft financial statements for the year ended 30th June. Fine. Now, as much as they have decided to change the accounting policy, right? So what this statement in number 6 is saying, it says that irrespective of that decision that we've came across in point number 1, when they were doing their draft financial statements, right, they have still made use of the old method, which is currently the draft financial statements are presented based on the, or not the, let me not say the draft, let me say the inventory on the draft financial statement is presented, or they've used a method which is the weighted average method. But now we need to fix that because we now know that they want to change that policy. So that's very important to know, understand? Because perhaps they could have said that perhaps that the new method was already applied. It also then gives a different meaning to your answer or the response that you need to provide to the required. But in this case, they're saying that the new method in the draft was not used. They have used the old method. Okay, that's very important. Now they give you what a summary of closing inventory at hand on 30th of June 2003 was. Okay. In accordance to the old method, those were the balances 2001, 2002, 2003. Fine. And then in terms of now the new method, the first in, first out, those are the balances 2001, 2002, 2003. Number 8 says the previous year's tax assessment will not be reopened, right, by SARS. However, they are going to, but the new policy of inventory valuation will be allowed. Okay, then we are sitting with a problem, right? Now, that problem now that we're sitting with it, it should not be a problem for you anymore because you now understand deferred tax implication, right? That whenever there is a different accounting treatment compared to what tax is doing, then we know for accounting purposes we will have then to create deferred tax item, whatever that item, whether it's deductible temporary differences or taxable temporary differences. So that's what that statement means. So this statement says that the previous year's tax assessment will not be reopened. So what they say is that whatever method that you've used for 2021, for 2002, we are not going to reopen these 2 years. So whatever that was submitted in the past or whatever that was there in the past, we will still use what is there, right? So which means that is the old method. And then now they say that, however, in the new policy will be accepted for tax purposes. So they say that now that in whatever that you do for tax purposes, it's fine not to use this, right? We will accept your new inventory policy. So the only years that is an issue is going to be 2001 and 2002, right? So in 2001 and then 2002, do we need to consider or do we need to account for any deferred tax implication? Yes or no? All right, that's going to be the first question. And then the second question, the second part of the question is that now in 2003, is there a difference in treatment as far as inventory valuation is concerned? Okay, so the question one is 2001 and 2002, do we need to account for any deferred tax implication, right? Just by looking at the figures here, you don't have to do a detailed calc. Just by looking at the figures, it's a matter of yes, it's a yes, or it's either a no, right? And then in 2003, is there a difference in terms of how accounting treats it and versus how tax treats it, okay? So the response to my first question will be that we will have to account for deferred tax implications, right? Because what we can see here, the closing balance on your old method is 130, right? But now, based on the new method, the closing inventory is 560, right? So there's a difference between what you will have to disclose your balance for accounting purposes, and then as well as what will be your tax base or your closing balance for tax purposes. So then already there is a taxable temporary difference, right? The same as 2002, you have a different closing balance compared to what SARS is going to reflect or want to see as a closing balance for tax purposes, which is in this case going to be your tax base. But for 2003, both SARS and Stockit Limited has agreed that we are accepting the new method. And I'm doing this for you because you will see when we need to do the deferred tax calculation, these principles are going to come through, and then this case is actually principal marks that you actually, easy principal marks that you can actually gather and accumulate very quickly. Fine. You are required, though, was not as generous as it used to be with the previous session that we've dealt with, right? Prepare the statement of profit or loss and other comprehensive income, right? You will also need to do the retained earnings section in your statement of changes in equity. And then as now it's very broad, it says the relevant notes, right, of Stockit limit. So as I'm saying that the question was not generous because it's not telling you what notes you need to do, but you need to know what notes that you need to do, right? So the first note that I would have expected to see from you, it would perhaps be, or not perhaps, it would be your change in accounting policy. The second note that I would have perhaps wanted to see, it would have been your income tax note, right? And then what would be the third one? There's no third one. I think it's only those two. So those are the notes that I would have expected to see from your response or from your solution, right? Okay. Now, what I'll do is, if now I was you sitting in an exam, I see this required. So this would have been the skeleton that I would have drafted out of my mind, because I know I've read what the scenario is. I know what it is that they require from me, because it's part of my exam technique that let me do my skeleton. Let me do my skeleton, and then from that, then I go back to the standard and then start answering. So I'm going to show you how the skeleton would have looked like. Okay, I'm going to share quickly that screen with you. Did I close this document now? Sorry, quickly. But why don't I see it now? Okay, there it is. Share. I'm not sure why it's sitting. Okay, there we go. Just gonna put it here for us. Okay, I hope all of you can see the tablet in front of you, right? Okay. So these will be the journals that if we need to do a journal as part of the exercise, then we're gonna put the journals here. And then, so in terms of your statement of profit or loss, right? This is how the statement of profit or loss and other comprehensive income will look like. So remember what I said to you, you will need to tell the marker in terms of who is the entity in question, and then what it is that you are doing here, right? Fine. Now, if you go to the question, you will see that your profit before tax, it was already given. So those are figures that you can put down to immediately, right? And I think what's also very important is in terms of the referencing, right? If you're going to get your calculation elsewhere, you will need to provide that referencing in case if the amount that you're going to put here is going to be incorrect, right? So referencing is very important. One. The second part of the question says that you need to prepare only the retained earnings section of the statement of changes in equity, right? So you would have had something like this. So it says Profit Limited, and then it's an extract from the statement of changes in equity, and then you give the year that's applicable, right? Because you're asked to do that. So you don't just leave this section here and then only write that, because what it is that the marker is marking, you know. So it's very important to include the headings and say what exactly the statements relate to. Right? So this would have been a skeleton, and unfortunately, this you would have to memorize it. Unfortunately, that's the reality of the matter. So your opening balance is given. You know already in the question that you need to do certain adjustment as far as your accounting policy is concerned. And then you know that your income in the 2022 year will be restated because of the result of the changes in accounting policy. And then also you know that your income, your total comprehensive income for 23 will also be restated as a result of the changes that has occurred during the current year. Right? Fine. So that would have been your skeleton. Now, the required that did not specify as to what notes you need to do. It's the required that's asking for you for notes now. But as we said, you already know that this required was dealing with the change in accounting policy, right? As well as the income tax expense note. So in terms of these questions, those were only the two. Those were the only two notes that you were actually required to actually perform, right? And then that's about it. Fine. Now, what I'll do is I will just we'll now start doing the question, right? Okay. So I just need to, why is this thing freezing again? I just need to shut down, close. Just need to close and save. Close that. Close that. Which one is this now? Close this one. Otherwise, I have too many items open here, then I don't know which one is which. Okay. So I'll just open up the template again, and then you're going to start answering the question. My PC is slow. Okay, there you go. Yeah. Just gonna share again with you. Okay, there you go. Fine. Okay, now you can read from your individual questions, and I'm also gonna read from my own question here. Fine. Now, there were various ways where you can approach the question, right? Various ways meaning that we know what is happening in number one, right? And then we know in number two is given the profit before tax. So you go and plot the profit before tax, right? Fine. Number three is giving us the opening balance for the retained earnings. Now you go and plot your opening balance in your retained earnings, right? Then we're done with, okay, we know number five deals with temporary differences in terms of how they are counted with which approach. And then we know number six is telling us now that these changes were not actually been taken into account with the draft. Now, your bulk of the information or the bulk where your calculations would have came from is from number seven, right? But you're gonna do it together, right? So if I were you answering this question, I would have had the calculations referring to the change in accounting policy, right? We know now that the new policy is the first in, first out. The old policy was the weighted average, and they've already given us the figure. So the closing balance in terms of the new method was 560, and then in terms of the old method would have been fine. So there would have been then a decrease. No, I'm talking nonsense. There would have then be an increase because initially the closing balance was 430, but now in terms of the new policy, now the balance is 516. And then you consider what the deferred tax implications are, right? Fine. You come to 22. Just forget this part for now. We'll get to this part. Then you come to 2002. 2002, in terms of the new policy, okay? And then in terms of the old policy, okay? And then we know that there was now an increase because the closing balance was 880,000. It has now moved to R1,000,000. So there was an increase of 158,600, right? Right. We come 2003, we know it's 1,081, 123. And then the old method was 887, 123. Fine, right? So we know that there was an increase in the inventory valuation in the inventory closing balance from 887 to 1,081. Right, fine. So obviously it's going to be different with you because what then I did is then to calculate what would have been the tax implication as a result of the increase now in closing stock. Right, the same I would have done there. Right. Now, before I get to here to this part here, I need to go to the deferred tax section because it's going to be the easy one that we're going to address quicker. Right. Now, remember we said that for 2001 and 2002, SARS is saying that is not accepting this new inventory valuation. Now, what I want to know from you is what is going to be the carrying amount as a closing balance in 2001, and then what is going to be the tax base for inventory in 2001 as well. So the first one I'm looking for is the carrying amount of the inventory. and then as well as the tax base. So what is the carrying amount, and then what is the tax base in 2001? What is the carrying amount in 2001, and then what is the tax base of the inventory? Okay. So the carrying amount would have been 560. That's what is given in the question, because we're now using the new inventory valuation policy. But for tax purposes, SARS says they're not going to accept this new valuation policy. So then our tax base should be based on the old inventory policy. Then already here, we then have sorry, we then have issues here because our accounting balance is different in terms of what the tax base is saying, right? I don't think this is right. So this needs to, I think that needs to change. It needs to change. Okay, because that is a liability. It's to change. So, because if your your carrying amount is more than a tax base, it's a liability. Yeah, that needs to change. Right. So the same you would have done in terms of 2002, right? 2002, they also did not accept the new policy. So our carrying amount would have been 1,039,000. So 1,039,000, and then our tax base would have been in terms of the old accounting policy, right? Which would have been 880,400. So there you go. And then you have now also a difference of 158,600. Fine. Now, for 2003, if you go to a question, the question told you that they will accept this new inventory valuation, right? Meaning that now your carrying amount as well as your tax base should be the same. And then in that regard, it does not create any deferred tax implication because the closing balance for inventory that you're going to use will be the same for tax purposes, right? Yeah. Now, so if you were asked to do a deferred tax calculation, this would have been a very easy marks that you could accumulate, right? Because with that as well, what then would happen is that you would then be able to calculate as to what would have been the movement in 2002 if you were asked not to do the movement. But you need to do the movement because you will see when you're doing the note for income tax, then you will see that the movement is required because initially, or in 2001, right? So let's assume that in the question, these are the only taxable temporary differences that we see in here. There is nothing else. Fine. So in 2001, at the end, you will stand in a liability of 36,400. Now, at the end of 2002, your liability has increased to 44,408. So there was a movement here from what it was there versus what it is. So remember, I said in my previous session that you will have X, you have Y, and then you're going to have Z, right? So X in this case is going to be your unknown, and then Y in this case is going to be 36,400, and then your Z, which is your final answer, is then going to be 4408, right? So that's always your formula to make things easy for you. And now you do your mathematical, so that actually should be minus. We stick with the liability, and that also should be a minus. So now, what happens is that now the difference between those two is now going to give you that one. So you'll say, I was sitting at 36,400, right? A liability, and now the liability is increased now from 36,400 to 44,000. So there was a movement of 34, sorry, there was a movement of 8,000, a liability. So what I would have done is that I would have debited this movement in my profit or loss, and then I would have credited this movement in my statement of financial position, right? This is the tax amount, and then that is your temporary difference movement, right? So in 2003, you would have done the same thing. 2003, you would have said, in 2003, you would have said, okay, now my balance in 2003 is low, right? But I know that my opening balance in 2003, or either my closing balance in 2002, or my opening balance in 2003 was that amount. So something happened here. What is that? So means that so X would be unknown again, and then Y is going to be a minus 44,408. And then now Z is obviously now a zero because the balance is zero in the current year, right? So what you'd have done is you would have said zero less, so zero less 44, whatever thousand, then it gives you an asset. It will give you an asset of 44,408, right? Because that's liability. Remember, I said that's liability, right? So I'm reflecting now here a liability as without brackets, but now reflecting an asset. Let me just do this quickly. I don't want to confuse you. Right? So you can adopt whatever methodology that you want, but as long as you are consistent, that's the only thing that matters here. So in this case, I am showing a liability without brackets, and then I'm showing an asset with brackets. So now here, so that's a liability, and then you end up at zero, which means that there would have been an asset of 44,408. So you have debited your deferred tax in your statement of financial position, and then you have credited your profit and loss with that movement, right? Okay. So you would have won the majority of the money. So the reason why I'm doing this, you will see when we come here to the note, you're going to require that movement, right? Going to require that movement. When you also come here to profit and loss, you will also need that movement, right? So you can decide in terms of how you do it. Fine. Now, so now we're done with deferred tax. Okay, fine. Now let's go back to the change in accounting policy because we have not yet addressed what the note is. So I'm just moving around now in the question to show you how you actually can get like the most maximum marks back. Now, what we need to do, which I think is crucial, right? We will need to go now and disclose this note. We have done all the calculations here. Now we need to disclose this note. So the note that we're going to disclose is going to be made up of two parts, right? We know with a change in inventory, there should be something that is happening in your statement of profit or loss, right? And then that thing or that line item is going to be a line item that impacts on your cost of sales, right? So something with cost of sales needs to happen because there's been an adjustment to our closing balances for inventory, right? So what you need to bear in mind here, these adjustments in your closing inventory and the cost of sales, it's not physical movement of stock, but these adjustments exist because of there have been changes in how we value inventory, right? So it's not to say that now if you had 3 units of what, let's say cell phones or laptops, it's not to say that now it would have changed now to whatever for you, but the value how it was valued, it would have changed, right? So this is a practical example that I'm a simple example that I'm using. Right now, so I'm actually giving you here simple, let's say, notes to say, okay, this in my disclosure note will have an impact on my statement of financial position. And then this part in here, this will be the part that will have an impact in my cost of sales, right? Now we're going to go to the note itself because we already have most of the information and we already know what is what are the adjustments that we need to make. Okay. Now, okay. So if we a quick question quickly. Now, based on this information that you've been given here, right? So what I've done for you, I've indicated to you what would have been the impact in the closing stock as a result of the change in inventory valuation, and I've also given you what the impact in the income statement is, right? But I've only given you the impact in terms of the amount. I'm not saying whether there's an increase or there's going to be a decrease, right? Fine. Now, if we're looking at 2003, the impact that we need to record in the profit and loss statement, was that an increase in your cost of sales or was that a decrease in your cost of sales? Okay, the same as for 2002. The impact in your profit or loss statement that we need to record, would this change resulted in an increase in closing in cost of sales, or would that have resulted in a decrease in cost of sales? Which one? Both of them is the same answer, because if you look at it here, the movement is the same. So what will it be? Will it be an increase in cost of sales, or would that be a decrease in cost of sales? What would be that? Would that be an increase in cost of sales, or would that be a decrease in cost of sales? Would that be an increase in cost of sales, or would have that been a decrease in cost of sales? Okay, so the only way to be able to answer that question, the only way to be able to answer that question, Timaka's is going to assist you now with the answer. Yeah. Now, so this is the formula that perhaps you should always use in order to be able to make that assessment, right? To say whether your cost of sales have increased or decreased, right? Yeah. I think as a starting point, you would expect that your cost of sales will have a debit balance, right? Will have a debit balance, and then obviously and then your income will have a credit amount, right? Fine. So that's your cost of sales, the balance, and then your income here, or let's say revenue, fine, because it's going to help you when you get there. Fine. Now, so let's assume in this case that purchases are zero, or let's not assume purchases are zero in this case, right? Because there was no actual purchases done, but it's just that we've changed the inventory valuation. Fine. Now, in 2002, your opening stock, okay, so there is sitting in 2001, right? So you'll be sitting at a closing value of 130, and that will become your opening stock, right? So 133, right? And then your closing stock in the current year would then be, say, minus, your closing stock will be, there's 130, is going to be 158,600, right? Okay. Now your closing stock in 2002 will now become your opening stock in 2003. That's your opening stock. Fine. So no purchases, and then your closing inventory in the current year would then have been 194. Now remember we said inventory to increase will have a debit balance, but inventory and then the opposite now, and then the credit now will be the opposite, right? So now if there is a credit balance, that's what is reflected in there, meaning that the cost of sales have now decreased, right? Because in the income statement, so in order to increase the cost of sales in the income statement, we would have debited cost of sales and the other account. But now there is a credit balance now, or a credit amount for cost of sales, meaning that the cost of sales have now decreased. That's a credit. So that credit reflects a decrease in cost of sales, right? Fine. So, fine. Now, so it's both the decrease in 2003 and in 2002. Those were the decrease. So what you basically do now, the amounts that you've already calculated, it's a matter of trying to transfer them now. You're trying to transfer now them to here. So a decrease in cost of sales in 2003, as well as a decrease in cost of sales in 2002, right? But now remember, a decrease in cost of sales also then has income tax implication, right? Because initially what would have happened is that if your cost of sales was more before this, it then means that you would have paid less tax, right? But now, because your cost of sales have now decreased, it means now you need to pay more tax, okay? So either you say that multiply by 28%, then you get our tax amount, right? And then you do the same here, we say that multiply by 28%, multiply by 28%, you get your tax amount, right? So these amounts you've already determined them here, but I'm just redoing them just to assist you. But remember, in your calculation, you would have already done them. So it would have been a matter of transferring from this calc here into your notes. And then that's where it's important now to then make that reference to say, let's say calc 1. So that in case if this amount is wrong, then your marker can come and see, but okay, how did they get to that amount? Oh, I can see, and then they will mark you. So it's very important that you actually mark your calculations, right? And if you for all of them here, you say like say from calc 1, fine. So now you're done with the first part. So what I normally say is this part is where it affects your profit and loss, but you don't have to write it that way. I'm just giving you tips. I'll get to this part just now, right? And then the second part here, it now deals with changes that will be effected in your statement of financial position, right? And then you also have already done that groundwork. You've already said how much inventory has increased by. There it is. In 2001, 2002, and 2003. We've already had those figures. So I think now it's only a matter of now trying to transfer all those figures now into the relevant blocks. Okay. Is that one? Fine now. So now in the current year, you will need to then account for tax-related consequences in that regard. And then for the prior 2 years, there will also be deferred tax implication in that regard that you need to account for, right? Remember, you've already done this calculation. There is that calc. You've already done it, right? And then there is that calc there. You've already also done it in this regard. There is the calc. That is 2002. And then that is 2001. Okay. So it's a matter of now you transferring now those amounts. So then you'll see whatever that you have on here as your solution, it will be exactly the same as what you see there. So there is the 93,600 2001, right? And then 114,192, there it is. 114,192, and then 139,680, there it is. Right. Okay. Now, so what we're saying that as a result of the change in accounting policy, right, that is happening in the current year, which is 2003, we will then have to go and adjust our retained earnings with these amounts. That's what needs to be reflected in our retained earnings, right? So if I were you, I would have then jumped straight to retained earnings, right? But before we do that, let's get quickly in terms of the narrative part. The narrative part on the information is very important because you cannot have a change in accounting policy in figures, whereas there is no narrative that tells the story in terms of what needs to happen, right? So in your solution that you have in front of you, that information is adequately being captured, right? And it's not information that has been thumbsucked. It's you're actually telling a story in terms of what it is that I'm doing here. So what happened, right? We know that there was a change in accounting policy that the director came to a decision to. Why did they actually do this? Because they wanted to be able to classify or record the income and expenses appropriately or accurately, you know. And then perhaps I think in an overall nutshell, it's actually to improve your your accounting reporting. So what you see in that, what you see in your solution, you should actually document it in that narrative. So it's very easy to say what it is that happened. They've changed the accounting policy from what method to which method, and then why did they actually do that, and then when was that decision taken to do that. So you don't even have to write something long, okay? Because remember, you also get easy marks for that. Now, remember I said now we're done with this. So the next statement that I think perhaps we should go to, we now need to go and address, is either you go and address your statement of changes in equity, or you go and address your profit or loss, right? Because remember, you already know how much cost of sales should be adjusted with, right? You already know that cost of sales must now be reduced by, where is this now? Your cost of sales in 2003 must now be reduced by 35,400. In 2002, cost of sales must now be reduced by 28,600, right? I'm just going to remove the formula so that you can see what are the figures, what would the figures were. Do that, and then I'm going to do that as well. Right. Now, these figures, it's what we've been given in your scenario, right? The copy and paste how it is, right? Now we know that we said as a result of the change in accounting policy, cost of sales now has reduced by that amount, And then that adjustment, we will need to reflect it in our revised, or let me not call it revised, it is revised anyway, profit before tax, right? So what we're going to say, here, we will need to reduce our cost of sales with this amount, right? Sorry, that needs to be a minus 4. Okay, so we need to reduce, because now we'll then have to pay more tax, because of in the past cost of sales was more, but now it is less. So now if cost of sales reduces, it means that now we're paying more tax, because whatever that you can deduct for tax purposes is going to be less now. Okay, and then the same thing that would have happened here, we would say, yes. Okay, it freeze now. Let me just save quickly. Let me just save quickly, and I'm going to open it now again because it's frozen now. Open now again, open now again, open now again. Okay, it's not this one. Now open now again. Okay, there you go. Just gonna share the screen again with you just now. Okay, there you go. Just gonna get to here. Okay, there you go. Now, did I adjust this one? Okay, so we're still busy adjusting for this one. Fine. Okay, let me just make things easier for you quickly. Do this. So we use information directly from the note. Otherwise, I'll confuse you. Okay, that's it. And then there, we also adjust now because there's a decrease in our cost of sales. Okay, go. Now, this will now be a new revised balance, right? In terms of what is now my new profit before tax, as well as what is my, so for 2003 as well as for 2002. Now we're done with that part. So The part now we need to come to now is the income tax expense. Right. Now, with an income tax expense, your challenge there is going to be, right? You need not forget your deferred tax consideration, right? Because remember, your income tax expense note is made, let's say in this question, is made up of two things, right? It will be made up of your current tax expense. I'm going to show you how we get to that, but also your deferred tax movement, right? So do not forget that. Then that amount that you get as your current tax expense, that is the amount that will be reflected in your profit or loss. This thing is freezing again, my friend. That is the amount that you're going to reflect in your profit or loss. But you're going to get to that calculation just now. I need to close again and then open again, unfortunately. Open again. So that amount, so it's going to be your current tax, right? So we know your current tax is going to be your taxable income. Okay, not your taxable income. So it's going to be your income after you've made adjustments, right? And then also taking into account your movement in temporary differences. It's open now. Let's go there quickly. Open. Okay, there you go. Okay, so this is how the amount that will be disclosed in your profit. So that amount that will be disclosed in there, it would have been made up of your current tax and then your movement in temporary differences. Right? Now, your current tax amount, how it's made up of, right? Remember, you already have what is already your adjusted profit before tax, right? So your adjusted profit before tax is going to say it is equal to my adjusted profit before tax, right? My adjusted profit before tax, right? However, with that adjusted profit before tax, remember, I've actually calculated what was the deferred tax movement in the current year is, right? So in 2003, the deferred tax movement was 158,600, right? Fine. So you will need to consider that, right? So this was my profit before tax, and then movement in temporary differences, movement in temporary differences amounting to, where is it now? Okay, it's that amount. Okay, and then therefore you have that plus that. Okay, and it gives you that, and then 28% of that will then give you, so it's equal to that times by 28%. Okay, and then remember, do not forget to then include what is your deferred tax movement, right? So your deferred tax movement would have been 44,408, right? That would have been your deferred tax. So there is your deferred tax movement. So that's what we've calculated as our current tax expense. Remember, our profit before tax, as well as what the movement in deferred tax was. Those were the movement, right? And then we take and then multiply that by 28, gives you 1,307,600, right? But now we need to take also the deferred tax expense movement in the profit and loss. Then you get to that amount. So now the amount of tax you're going to disclose in the income statement for 2003 is going to be this amount. That's the amount that you're going to disclose. Okay? So the same thing then you would have done for 2002. So for 2002, what you do is you already have what is your profit before tax, right? And you already have what your profit before, you already know what your profit before tax is, but also with that, you already know what was the movement in temporary differences, right? So what you do is your profit before tax, and then you I'm going to share the screen just now. Your movement in temporal differences should be how much? Just want to say quickly. Movement in temporal differences. It should be 28,600, right? Okay. So what you do is, so that's 23, and then this is 22, right? So our profit before tax is given. There it is. Remember, this is the adjusted profit now, right? After we've taken into account. So adjusted profit after taking into account change in policy. So you need to keep that into mind. It's adjusted profit after taking into account inventory policy, right? Okay, so you say it's going to be, sorry. So that's a profit before tax, right? And then that would then be also your, so your movement in temporary differences, right? And so now it's a matter of copying and paste. That's your movement in temporary differences. Then you get your answer here, that, and then you multiply that by 28%, right? So you should get to 571,200. So there is the 571,200 in terms of how I get it. But then remember, your income tax expense in your statement of profit or loss is made up of your current tax as well as your deferred tax expense. We've already determined as to what is the movement, because 8,008, right? So there it is. So the amount that you then see in the statement of profit and loss is going to be 579,208. 579,208. Okay? And then there is your figure. Right. Now, there is one item that we have not yet addressed. We've done the accounting policy change. We've also done the income tax expense note, right? However, we have not yet addressed another required, right? So that other required then related to the statement of changes in equity, right? The nice thing about this, the reason why you leave it for last, because in order for you to be able to answer this, you were actually required to start here and then either here or either here, right? Because you will see that the amounts that you need here, it comes from your profit or loss, right? The same as the amount that the adjustment that you, the restated profit or loss that you need, it comes from your statement of profit or loss, right? Fine. So obviously you have to memorize this, the unfortunate part, right? So your opening balance, remember we recorded in the beginning, it was given, okay? And then your change in accounting policy in your note, because remember you said in your note, this figure here in the end, your increase in equity, that balance in the beginning, that will have an impact. There is the date that will have an impact in your retained earnings. So that balance comes directly from that, right? Now your restated balance then will be 3,083,000. Now your changes in the equity now as a result of the change in your statement of profit or loss figures, right? Because remember, the profit or loss figures now have now changed from that to that, right? So initially that was not your profit before tax, it was a different figure. But now we have to take now into account what the change in accounting policy was, right? Then as a result of that. So in 2002, we will have then to adjust, or not adjust, we will then to reflect now a revised amount of is equal to 1,489,392, right? And then in 2003, you would have then have to reflect a revised profit of 3,248.28, right? There's something that I'm missing in. So it's total comprehensive income for the year. Okay, that's that. Okay, we're done with that. So that's right. Okay, that's fine. So that's the tax 1263. 579,208. That's fine. Okay, that's fine. Oh, did I mix the number? So that's 2002, that's right. And then that's 2003. So that is So that is correct, okay? So now your total balance at the end of 2002, sorry, 2003, not 2002, 2003 would be 7821,200. And that is how you would have answered the question. So this part here is basically a copy and paste in terms of what you have done in previous section, right? Because everything you would have already worked it out for you. All right. So I know in terms of how it looks like, it looks very easy, but it actually takes practice, right? So I'm just gonna pause quickly for a moment, and I'm not sure if you guys have any questions. Then you can pose those questions because I don't think I've actually allowed you time to actually pose questions in that regard. But this question was actually very straightforward, simple and straight to the point. I think the only items perhaps where perhaps you guys would have gone wrong is in terms of when it gets to this part. So as I'm saying that, do not forget your principles in terms of how an income tax expense note is structured, irrespective if you're dealing with IAS 8 requirements, but do not forget your principles of your principles in terms of IAS 12. All right? So yeah, so I think this is how I would have answered the question. And then I would have finished the question within the allocated time, right? So what we're going to do next week is, I just want to switch on the light. What we're going to do next week is, so next week we'll still do a question that also deals with IAS 8. So perhaps where we cover in terms of prior period error, as well as covering the change in accounting estimate, right? Also, they're also fairly straightforward. There's nothing complex in terms of this specific standard. But the problem then is in terms of how then do you actually get to those calculations. So your principles as far as when do you consider deferred tax or when do you account for deferred tax will remain the same, right? How you do your note for income tax expense, it will remain the same. So there's nothing that changes that much. Most principles remain the same. Yeah. So as I'm saying that some of these things you unfortunately need to memorize because that's just the reality of it. It's not going to be given to you. The reality is that you need to memorize them and that's it. And I think by now you should be comfortable in terms of which items or what items you then treat for different tax purposes. If there's a different treatment for accounting, which is this part, this is what tax is saying, then you need to consider the different tax implications. However, even though there are no different tax implications, right? Let's say it's nil, you will need to tell the marker in terms of why is it nil. So it's not going to help you to actually leave this part blank. Otherwise, you're going to lose marks there. You will need to tell the marker that, okay, it was inventory, it was the carrying amount was that much, and then the tax mix was that much. Therefore, there is no deferred tax. So you get a mark for that because you understood what the principle is. But simply leaving it blank is not going to help you, right? But also, what's important is that most of you guys struggle in terms of doing the movement, right? So I suggest that you go and practice in terms of how you do the movement. If you have this narrative here, or this formula, or this mathematical equation, you'll never go wrong with it because the principles remain the same. It's only amounts that are changing, the principles remain the same. But what's important is your indicators. If you're saying that you're treating an asset between brackets, then you need to remain consistent. If you're saying I'm treating a liability between brackets, then you need to remain consistent, right? Because sometimes even with me, I sometimes I can get confused. So that's why right at the beginning, I take a standpoint and say assets, I'm going to reflect with a bracket, or liability, I'll reflect with the bracket. So as long as you say which one is which, right? So that it's easy to understand. Okay. So I think before we close off, if you guys can complete the attendance register for me, as well as if you can complete the evaluation form, The links are pasted in there. I'm just going to paste the attendance register link. And then thereafter, yeah. So Claudine, did you put for us the evaluation form? I think it's there. Okay. So I think for now you can just complete the attendance register. It's gonna be very quick online. It's only a few input fields that you're required to do. And then that's about it. So I'll see you guys now next Tuesday, same time, same place. I'll perhaps try and cover, even if it's 2 questions, but then it's not going to be in so much detail, right? So I'll cover one question in full detail, and then one question perhaps give guidance in terms of what, if you need to respond to it, what it is that you need to consider in answering that question, or how would the format would have looked like, and then which part would you have addressed in order for you to gain maximum marks in that question. So I think that's about it for tonight, and then I will see you guys next week, same time, same place. So yeah, thank you. That's it. Claudine? Hi, Claudine.